Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 25 minutes here on Options Guide TV. All right, so we had an interesting week in the markets. The tendency is to set new highs, and the VIX is actually showing that. So we got the VIX index right around 13. We had a jobs report this morning, uneventful as far as the markets are concerned. We got the SPX up 20 points at this point in time, or a third of 1%. And the Russell 2000 is up a little bit too, which is always good to see the Russell 2000 in the positive in this rate environment. So things overall are looking cheery. We have the S&P 500 index pushing up against the $6,100 mark. So it's not wasting its time trudging forward, setting new highs. So what we're going to continue. So this week we had a bullish outlook on almost everything, and I still kind of feel that way. Once again, that we had the euphoria of the election being over. Markets have I don't know, just been positive overall across the board. Mega cap tech. We got Apple setting a new all-time high. Everybody's always saying that Apple's getting overvalued, but it just continues to keep going up and up. Google got beat up a little bit, but now that stock is bouncing back too. So we have Google actually today up $1.55, or almost 1% so far on the open. And that stock, once again, that it's more about speculation on if they're going to lose their stranglehold that they have on search because of all the new AI stuff that's out there. But that's the only thing that's really holding the stock down. It's one of the Meg 7 stocks that actually trades at a very decent valuation. So with all that said, let's start by looking at our Amazon trade. We mentioned Amazon on Monday, and let's go to the Tradier Pro software. And we mentioned Amazon on Monday, and we kind of flippantly mentioned that if you look at the chart in Amazon, and let me get that chart up. And if you look at the chart in Amazon, that we were hanging right around a resistance level, right down here, right at the 209 mark. And look at what has happened. Now, okay, so overall, they had a big conference, and a lot of people from Amazon spoke, and a lot of people said a lot of good things about how AI is helping their business. Now, this was just a reiteration of all those same comments that they made on their earnings report. And this was the move up in their earnings report. Got beat up, came all the way back down to the 20-day moving average. And now look at it just going parabolic. But this was the area that it was, I think, for lack of a better word, struggled to get through. Right where this small little gap was. And once we gapped up on that, it flew through until it got up to here, to the high that was the earnings report. And now the market just is looking really strong in Amazon. So mentioned it here that this would be a buy if we broke out to the upside. Got up to here and decided that with this move, yeah, let's get long. And so we did. And we did it because of the day of the week. We were on Wednesday's Options Guide TV, and we could do a short-term vertical call spread, otherwise known as a bull call spread. And the strikes that we used, Amazon was trading at 218 at that point in time, and right now it's 224. We went just out of the money. We bought the 217. Well, actually, I guess this would be just in the money. We bought the 217.5 strike calls, and we sold the 222.5 strike calls. A lot of twos in there. Makes it real fun to say. And we went only 2 days. So 217.5, we're going to be buying that one, and 222 and selling that one. So it's nice that that Amazon was nice enough to actually just go beyond the 222.5 strike. which means that by doing that option contract, we actually did better than buying the underlying outright. Well, in theory, because we did capture a decent amount of premium. We got 67 cents, which is now that time premium that's left in that option contract is 17 cents. And it's just half a day. So at this point in time, with the strong move today, up almost 2%, you could let it ride a little bit more, but we're going to come close to that $5. Yeah, we're very close here. We're $4.88 on the midpoint, which it's bouncing around a little. So here's the way I would take this trade is I would go and I'd be happy to take $4.90, give up a dime out of the $5 total that we could make on the trade. But if you really want to, you could do the $4.95. You could come in and say, I'm going to sell, flip the script. I'm going to sell this option contract. It would be a close. I'm going to click open because I don't want it to get mad at me because it was a paper trade. And we're going to buy to close this option contract. And we would say $4.95. And at the very least, I would have that in there. You can deal with exercise and assignment, but you are long an option contract that's in the money and you are short an option contract that's out of the money. So there would be additional transactions. You'd be buying the stock at $117.50, selling the stock at $222.50. If you're in an IRA account, a retirement account, not that big of a deal, but it does make the transaction a little bit weird if you're doing it in a taxable account. And I don't talk about taxes much. It's not meant to be recommendation, but you're talking about just buying and selling option contracts versus buying one, getting assigned, selling, purchasing the stock, and then, exercising the stock and buying the stock at the lower price and then getting assigned and selling the stock at the higher price means you're dealing with stocks, which just gets a little bit more complicated. I'm happy to give up a nickel just to deal with just the option contracts. And so you close it all out. And it was quite simple then. You just bought an option and you sold it, and you sold an option and then you bought it. Straightforward. That's always the way I've looked at it. Okay. So another reason why I like to trade index options too is you don't have that stock. They settle in cash. And so it's a lot more straightforward when you're doing those types of trades. If you have any questions on that, feel free to put them in the chat box. I'll be happy to address anything that you might want to talk about as far as long call spreads are and trades that are profitable in this instance. Now, it is interesting to see that if we would have bought, because I do have it on my screen grab, and I'm sharing the whole screen. So let me do this. Because this one's a close one, right? If we would have bought the 217 option outright, if we would have bought this, we would have had risk with time decay, right? Especially if we were wrong on our forecast. So the 217.50 option contract, the market was at 218. I'll go bigger. The market was at 218, 217.50. This is the quote from Wednesday. We see it trading for $2.51. Now, if we come back and we look at this trade, right, $2.51, it's now $7. So you're up about $5 on it. $2. What did I say? $2.50. Not quite $7. It would have to get to $7.50 to be up $5 on the trade. So on the spread, we paid 78 cents for it, and we are going to be selling that now for $4.95. So on that trade, we're looking at around $4 that we made on the trade. So we're very similar in what we actually accomplished by buying. We would have had $2.50 of risk, total risk, if we were dead wrong. We ended up with only 78 cents of risk. And because we did the spread, maybe I'm not explaining. I feel like I'm not explaining that. If we bought this outright, the market was at 218. If we bought the 217.50 strike, which is a very viable strike, close to where the money is at, a little bit in, getting a 56 delta, you pay $2.51. Market ran up, now trading for around $7. So you're looking at $4.50, right or about there. But you had $2.51 of risk. Now we did the spread. We brought in 78 cents, right? That's our total, or we didn't bring in, we paid 78 cents. So we greatly reduced our risk if we were wrong. And because the market came up and got to our strike, we can sell this now for about $4.95. We're actually getting there, very close. And we made almost the same amount with a lot less risk. So, moral to my story is we decided to do this trade with 2 days to expiration. If you are taking a short-term outlook on the market with well, it was all because of charts, right? Because we had that breakout to the upside. That's the reason why we decided that we were going to do this trade. As a matter of fact, it wasn't even planned before we got on the show, but the chart just looked kind of enticing. So that's why we did the long call spread. That on a 2-day period, it almost always behooves you to do a long call spread as opposed to buying an at the money or just in the money option contract because of the way time decay works. Now, you don't have unlimited upside, but you only have 2 days for the underlying stock to move. So unlimited is a tough number to get to. I guess that's all that I'm trying to drive home is that we did a spread. We made almost the same amount that we would have if we bought the option outright, but we had a lot less risk up front when we put that spread on. Okay, so let's go now and look at how our SPX trade worked out. And I'll pull up that trade 1 second here. The option chain is such a big haul to pull up because there's so many option contracts in the S&P 500 index now. And we were bullish on it. We sold the most at the money option contract when we did that trade. Come on up. We bought the 630 and we sold the 640. So we were 10 points wide, paid $5.90 for it. 630, bought this one right there. All right, sold that one. So we should be close to 10, but we're not going to quite be there. Yeah. Computer pros trying to pull up the S&P 500 index chain. There we go. Close. 1 second. There we are. Yeah, not bad. Well, 995, it was there for a second. Yeah, it's jumping all the way around. So this is where my limit would be. I would put it in at 995. We see this number jumping into ticks. That's just because the bid-ask spreads are getting deeper in the money and the bid-ask spreads are getting wider. But I would let that ride for $9.95 and close that out. We put it on for $5.90, and the maximum upside that we could get is $10. Now, in this instance, we are going out 5 days in time. So the market had more time to move, and it did. It was obviously very bullish over this week in the S&P 500 index. We started the week when we looked at this trade at 11 o'clock Eastern time on Monday. The market was at 6029, and now it's 6086. And if you bought the option outright, you would have paid 630. Was that? Oh, that's right. That's right. We did the 20th. Doggone it. So we still got a little bit of time in this one. Let's say so let me finish my thought. So if you're looking at a Monday trade and you have an entire week, in my mind, that is totally different than the Amazon trade. In that if you put it on a Monday and you're looking to close on Friday, then buying an in-the-money option contract is a little bit more feasible because you have more days for the underlying stock to move if you are correct on your forecast. Now, you're going to still greatly reduce your risk by doing a long call spread, but having a little bit more time for your forecast to play out, like we were thinking in the SPX, we're going to actually go out to December 20th, which it still has 14 days remaining. I forgot that we went out that far this time around. But I would, the further I go out in time, the more apt I would be to just buy an in the money option contract if I like my forecast. I guess that's the moral to my story. When you have 2 days remaining, selling that one option contract doesn't hurt you that much. Or 1 day if you're looking at a trade. If I'm trading daily options, I'm almost always going to look at just doing the long call spread, because I don't expect the marketplace to just, I put it on at noon and by the end of the day, it's just going to take off. I'd rather reduce the risk if I can get some premium for the option contract and trade it that way. And that's the moral to my story and the moral to Options Guide TV. If you have any questions, please do put it in the chat box and I'll be happy to address it throughout the show. Let me see where I'm at here. And then the other trade that we looked at this week, and we're going to come back, and this is kind of a longer term hold, but is BlackRock. And I do like the financials. I like the XLF. The XLF is done well, but it's still, a lot of things are undervalued. BlackRock is in that space. They manage a ton of money in general. And they actually had some news come out this week talking about the fact that the loosening of some of the regulations might allow them to do a little bit more in the mergers and acquisitions space and just getting deals done in general. The stock popped on that, but then it gave it back up. So it's fairly volatile within the price range. But when we started this trade, we're up about $10 on the trade. And we did a long, deep in the money call option and bought and sold a shorter term option contract against it, which would be a diagonal spread. Or in my book, I actually call that a fig leaf, kind of, depending on how long we're going out on the option contract. So this is one of the positions that we're going to look at over the next couple of months. And I don't actually mind doing that strategy on the XLF. XLF is a lot lower priced underlying. Let me see if I have it over here. And if I don't, we'll just add it. And it makes it much more feasible to do the trade. The option contracts aren't as expensive and they aren't as volatile. There's the good old Goldman Sachs. Maybe that's a hint that we should do one in Goldman Sachs. So the XLF is at $50.40 as opposed to a $1,000 stock. XLF does have a lot of Berkshire Hathaway in it, a lot of on the insurance side of things too. So it has some exposure in that world. All right. Lost the questions. 1 second. Let's pull back out here. And come just to me. And there it is. Okay. And I did see the question. Okay, on Monday you did the 12.6, but changed it to 12.20 on Wednesday. Oh, all right. Thank you, Fresh. Then that would explain my confusion. I guess I must have screwed up that second expiration. So, all right. Did you put it on by chance, Fresh? Because obviously it's worked out. Interesting enough. But the moral to the story is, if I'm looking at these trades and I'm looking at the chart and saying I'm going to do a shorter term trade, I don't mind doing a spread as opposed to just buying an option outright. And that proved its point this week in the Amazon trade. Strong move to the upside. Spread did just as well with a lot less risk. SPX, I'm almost always going to do a spread in the SPX on weekly if I'm going to do a weekly option, because they're just so expensive. There's just too much risk that's involved in buying an individual option outright. But also in the SPX, I don't mind letting that trade ride to expiration. So we'll go back to the SPX trade. And here's the thing. If you haven't traded index options, you're going to want to go to the options playbook and go to the management position or the additional information and look at about trading index options, because we're at $9.95 on the 12/6, which is from 6:30 to 6:40. So we're at $9.95 on that trade. I don't mind letting this one ride out. In Amazon, if I'm in a taxable account, I'm going to end up buying and selling the stock. But in the indexes, they settle in cash. They don't come in and give you all 500 shares of stock in the S&P 500 index. And that's a huge benefit. That's a huge benefit, especially in a taxable account, because there's something called the 60-40 rule, which means that 60% of your capital gains inside a trade like this are going to be long-term and 40% are going to be short-term. So they give you the benefits, they give you some tax benefit inside the SPX options. Now, I'm not a tax advisor, not meant to be tax advice. I'm just stating a rule. It's called the 60-40 rule if you want to go on out and do a little bit of research that's behind it. So I don't mind in the SPX allowing this one going to expiration. The Amazon trade, I'm going to give up that nickel. I don't want to deal with any of those transactions. Now, once again, you're in a retirement account and you're doing some of these strategies, which I'm okay with. Almost, in this day and age, brokerage firms came around and do allow you to invest in retirement accounts. But if I'm in that, then it just doesn't matter because I'm not worried about the individual transaction and keeping track of that trade. All right. So yes, you did. Okay, good. That makes a lot of sense. 9:30. Oh, solid. So able to close yesterday at 9:30. That's pretty good. I would definitely not want to take the overnight risk. So that's a solid trade to be able to do that on a Monday to a Thursday trade. Thanks for sharing, Fresh. I appreciate that. Now, what we'll probably do is we'll come back, and I still think the euphoria happens. At some point in time, people have to. I do expect a decent sell-off. I'm not talking 10% or anything like that, but a decent downside move, probably around the inauguration. I don't know where there's a specific date, but I think there has to be a buy the rumor, sell the news event, which you see on individual stocks all the time. So I'm actually going to get long VIX options because the VIX wants to trade right around the 13 level. And I'm pointing out on my screen. Okay, I'm up and running here. Around the 13 level going into the inauguration. Now, I've never really thought about doing that before, but I do feel like there has to be some sell-off, and it's easy for the VIX to get up to the 15, 16 level. As a matter of fact, that's where the VIX likes to trade. That's about the 200-day moving average in the VIX. So you're not asking it to do much. But you can do a 2-point wide spread in the VIX, it'd be okay. So that's what I'm looking to do going into the inauguration. And we'll probably talk about that trade. Well, we're a little bit closer to Christmas time that we'll probably start looking at putting that on towards that holiday. Now, in the SPX, on Monday, we'll come back. I don't want to ride a long trade over the weekend. I don't want to do the same type of trade that we did on Monday over the weekend, but I wouldn't mind putting it on Monday morning, see what news blindsides the market by Monday. So today we're not going to have a play that we're going to put on, not a paper trade. We're going to ride the weekend. We do have our BlackRock trade on, which is going out all the way out into 2025 and selling some short-term options. So the only concern in there is that if the shorter-term option contract actually came up and got closer to the strike at this point in time, and it's going to be a volatile stock to trade. I wish the bid-ask spreads were tighter in BlackRock because I really like the fact it's $1,000 stock, and we lost Amazon and Nvidia, all those stocks that were thousands that would trade as $1,000 because we lost them because of stock splits overall. So they all came back to the $100 level. But a high premium, fairly volatile underlying is always fun to trade. But in BlackRock, we just don't have the open interest that I would like. All right. enough said. Okay, that's enough questions. Thanks for sharing today. Appreciate it. If you do want to, oh, we got more questions. Oh my gosh. Turn around and look at what I see. Let's go to Mega. General question. Well-known Santa Claus rally, true most of the year in the past. That's a question mark as well. Yeah, it is. Now, Santa Claus rally is what Mega is talking about here. And the Santa Claus rally is literally between Christmas and New Year. And it has a lot to do with money managers. Well, the theory is money managers adjusting their portfolio to get into the year end. So a lot of times markets will rally between Christmas and New Year's. And I would say in general, that is true. There are, I have a couple of friends that are on X.com that always talk about the Santa Claus rallies and goes back and does a lot of back testing in those concepts. So on X.com, there's a lot of information about it. In general, I do think it's true. We did have a big crash a few years ago going right into Christmas. And if you were on a plane or whatever, it might you wouldn't even know that it happened because the market came flying back very quick. But I don't mind doing that getting into December overall. And on Options Guide TV, we've talked a lot about the fact that once the election was over, we wanted to get long the market and do bullish trades, and that's really kind of been the theme. There's been a couple of bearish trades in the middle, and if I'm going to get bearish on the market, I wouldn't mind doing that on a Friday because Mondays have a tendency to be volatile trading days, especially if they're down days. So I would say, Mega, yes, the Santa Claus rally, there is some truth that's behind it, and the theory is solid. It doesn't always happen, just like anything. Past performance isn't always a guarantee of future results, but I don't mind getting long the market going into the end of the year. Okay, and then Patrick, bring it up. Let's go, Patrick. I appreciate that you appreciate that, Patrick. I really do. I really do. Okay, and I think that's going to be it. All right. Thanks for joining. Let everybody know about Options Guide TV. Please share it. If you want to follow me on X.com, we do stream this live through the Tradier X.com, also through myX.com. If you want to ask questions, if you build a profile in hub.tradier.com, you can get access to all the speakers. It's free to do. And you can ask questions during the show. Also, you can ask questions in the X.com platform and if you're logged in on YouTube. So thanks for making this a live show and participating in my reindeer games. And we'll be back on Monday, probably looking to do another long SPX trade, but obviously based off of what we find out over the weekend. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.